So with that being said, last week we got to take a look at our very first depreciation method, which was the units of production. Okay, so here I'm going to be introducing you guys to the other two depreciation methods, and then we're going to learn one other special method. Okay, so with that being said, okay, so now we're going to be looking at double declining. All right, so again, we're going to be utilizing the same 5 components, right? These are very, very crucial in order for you to complete your calculations for depreciation. So, of course, you need your cost of the asset. You need the estimated useful life. In this case, you will definitely need the useful life versus the number of units that it can produce. So, in this one, it is time sensitive, all right? Another thing, too, is we have a salvage value or a residual value. We need to also consider the date of when you placed it in service, and lastly, to determine the actual depreciation method. So, if you guys remember from last time, they're pretty straightforward. Cost of asset, it's basically everything you need to total up everything. Salvage value or residual value, because we're a sole proprietor, we're able to use either or, the 5, 7, 9, 11 rule, or we can determine our own. And then also residual values, we can determine that because we're sole proprietors. We can allow ourselves to have something. And then, of course, the date that we place in service, if it's within the first 15 days of the month, you need to depreciate that month. If it's after the first 15 days, so it's the last 15 days, you need to not depreciate that month and depreciate the month after. Okay? So with that being said, we looked at a total of 3 different depreciation methods that we will be learning, which is units of production, straight line, and double declining. So today it's about double declining. All right. And let's get started. What is double declining? Well, of course, with the idea of double declining is that you have a tendency of using the item more often in its early years versus its later years, okay? And a perfect example of typical things that you would normally see would be anything that's electronic or an appliance, okay? Usually it's typical, right? You get a laptop for school, right? You're more likely to use it very, very, very in the very beginning of its life. But as you stop school or you're done with school, then it just sits there, right? And that's what this applied knowledge is. It's basically saying, well, if we're going to utilize it a lot in the beginning of its life, then therefore we need to double up because we're using it so much in the beginning of its life that we need to just calculate it twice as much. And then eventually it reaches its ending point, and that is it. Okay? So the formulas that you will see here is depreciation basis, which is going to be the beginning of the year's book value. Okay? BOI book value. Okay? And we'll see what that means, okay? So every time we solve for a book value, we're going to take that number and we're going to transfer it over, and that's going to be what your depreciation basis is going to start off with, okay? So that means every year the depreciation basis changes, all right? Then we have the second equation, which is the depreciation rate, which is going to be the number 1, just like the number 1, over the estimated useful life. And we're going to multiply it by 2. So 1 over any number makes it a fraction. So that's exactly what we're doing. We're going to evenly divide it by the number of useful lives, and we're going to multiply it by 2 because we're decreasing it twice as much, okay? And then what you're going to do for your depreciation expense, it's going to be your depreciation basis times your rate. All right? And then, of course, your accumulated and book value, these formulas stay the same. All right? So let's go ahead and dive into our first example here. So here it says to record the depreciation expense for the first year. Here you have a machine. Its cost was $15,000. Its salvage value was $2,500, and its useful life is 5 years. All right, and for the number of units that it could produce is 10,000, and the date that you place into service is January 1st. Now, assuming that we're going to be depreciating it for the whole year, so that means December 31st will be when we actually make our adjustment entry. So in this case, let's go ahead and solve one at a time. So the depreciation basis is going to be beginning of the year's book value. So what is my book value right now for my asset?
The $15,000.
Perfect. There it is. Exactly. That's exactly correct. It's what you start off with your the total cost of the asset, right? Right now, its current value is $15,000. Good. So then, how do we solve for the rate?
Well, that is the depreciation rate is the 1/5
Mm-hmm.
times 2.
Correct.
So that's fraction, right? I don't have, uh,
Well, what is 1/5?
I don't know. I don't know fractions.
Okay, so 1 divided by 5 is exactly what a fraction stands for. 1 divided by 5.
So it's the 0.20.
0.20 times 2.
Right. Okay. Oops. So that. Oops. Sorry. Do it on a calculator.
That's fine.
Times 20. Is it 40?
It's 0.40 or 40%. Okay. Of course, when we actually multiply our numbers across, it should be 0.4. But in this case, it's because it's a rate. It's going to be 40%. Okay. So then the depreciation expenses is going to be your depreciation basis times your rate. So what is 40% of $15,000?
6,000.
6,000. Good. All right, and then let's solve for our accumulated depreciation.
So let's see here. Previous years plus current year. So there's no previous year.
No previous year.
So is it 15,000?
What's the current year's depreciation expense?
Oh, sorry, the 6,000.
6,000 is correct. So that's what you start off with. So therefore, what is your book value going to be?
So it's 15 minus 8. 6,000. 9,000.
9,000. Okay. Once you determine that this is 9,000, so what happens is this number, your book value, is going to be the beginning of the year for number 2. So your depreciation basis for the second year is going to be the beginning of the year's book value. So that means your depreciation basis is $9,000. Okay. All right. You wanna solve for the rest for year 2?
Okay. Let's see here. So the 1 by 5 is 20
Mm-hmm. Times 2.
times 2. So it's still the 40.
Still 40%. Good.
Or 0%.
Mm-hmm. What's 40% of 9,000?
3,600.
Okay, so here you go, 3,600. Okay, now of course, when we continue on so forth, right, we add our depreciation expenses together. So 6,000 plus 360 gives us 960, which then our book value should be 5,400. So as you can see, there's a trend going on here. And what you're going to notice is that what happens is that every year your depreciation will change because it will always be your book value, the beginning of the year's book value. Okay? So once I've solved and keep on going, right? I'm going to notice I'm at year 4, and what is my book value now?
1,944.
1,944. But what is my salvage value at?
2,500.
2,500. So therefore, no, it cannot be valued at 1944. So this is where I was teaching you yesterday or the last week that once we come to reach our capacity, in this case, our book value is below our salvage value. So this is where we have to decide to work backwards. Okay, so in this case, we can't go forward because we actually don't have a clue on how much we actually need to be at because we don't know what our results is going to be at. So we have to work backwards. And how we work backwards is pretty simple. We got to look at our depreciate. We have to look at our book value. It needs to equal our salvage value. So therefore, we need to work backwards to solve for our actual accumulated depreciation. So in this case, my formula here is, so my book value is equivalent to 2,500, which we've already solved. Now we got to work backwards. We got to solve for our accumulated depreciation, which is going to be the cost of our asset minus our book value, right? And that's going to give us 12,500. Then we got to work one step more back to solve for the depreciation expense, which if we take the original formula for to solve for the accumulated depreciation, right? So that means my formula here is going to be depreciation expense should equal to my accumulated depreciation minus my previous year's accumulated depreciation, right? And that will give me my total amount of 740. Okay, so this is us taking a number. So here our original numbers look like this, right? We got to find our way to solve and work backwards, right? We cannot go forward because we just don't know how much we can predict as far as the depreciation basis. We wouldn't know. We can't find that out. So in this case, we're going to work backwards by using the formulas and plugging everything in. All right? And then we solve for this. Now, notice one thing. How old is my asset?
4 years.
It's only been 4 years and it already depreciated to its complete divinity. And that will happen especially when you're doing double declining. It is time sensitive, but it may have a possibility of its life being short because of the notion that you're decreasing it twice as much. So that means the number of years that it can last it could last longer or it could actually be a lot shorter. Okay, so that's one notion that you need to take note of is that double declining, there is a possibility that your asset may not last its 5 years. Okay, especially if you have a salvage value. All right. So here's a few things that I want you to notice. That again, the useful life, it may not reach 5 years. So it is definitely less than 5. In this case, our beginning of the year book value has changed due to what we solved for our book value for every year. All right. But what you're going to notice is the rate will always stay the same. The rate will always be 1 over the estimated life times 2. So if you solve for 1, the rest of the problem is pretty much straightforward. It's going to stay the same rate. And of course, your depreciation expense will depend on obviously your depreciation basis. So when you're just multiplying them across. So here for solving for most of the answers, it's kind of self-revealing, meaning once you solve for one row, you just bring down the answer to the second row, complete it, and then bring it down to the third row. So in this case, the only thing that you really need to really do the calculation for is solving for the depreciation expense and also solving for the book value. Everything else is pretty much straightforward. Okay. Any questions on how we solved for double declining?
I have none yet.
Okay.
All
right. Okay. So let's go ahead and answer the question is, let's go ahead and journalize for the first year of depreciation. So again, what accounts am I going to be looking at?
Depreciation
Mm-hmm.
or
Depreciation what?
the depreciation expense.
Correct. And then what's my credit account going to be? Remember, it has to be that contra account.
Let's see here. Accumulation expense.
Accumulated depreciation, no expense. Okay,
Oh.
so close. Good.
Oh, okay.
Okay, so you have the depreciation expense and you have the accumulated depreciation, right? And it's going to be for whatever you solved for that first year. So in this case, we solved for it to be $6,000. So there you go. For the end of the year on December 31st, I'm going to recognize that $6,000 is going to be my depreciation expense. Okay? So every year your journal is going to look different. Right? Here's the journal for the second year, of course. It's going to be the same exact thing, except the depreciation expense, which we did solve from our table. We solved that it was going to be $3,600, and there you go. And that's the journal entry for you. Okay. So every year the depreciation entry will look different. Okay, so the expense number is always going to be different. Okay, so any questions on how to journalize it? This is pretty much the straightforward one. You just have to just remember what accounts you need to use.
Okay, yeah.
Okay,
No, I'm good. I have a lot of background noise. So.
that's fine. Okay, so then we talked about what partial years is, right? We talked about how this is going to be affecting how you measure and when you actually start depreciating. Because the one thing that we have to remember is that one rule. If it began sometime in the beginning of the month, then you depreciate it that month. If you put it in after the 15th, which is anywhere between the 16th all the way to the 30th, the other last half of the month, you don't depreciate that month, you have to depreciate the following month. So in this case, right, example here is that on October 1st, a machine was purchased for $10,000 with a useful life of 5 years and its capacity of 25,000 units. Okay, we don't care about how much it could produce, we care about the time or the useful life it has. Okay. It has a salvage value of $2,500. 100 at the end of its useful life, and the machine was placed into service on October 14. Record this transaction, okay, or the depreciation. So, because we have one piece of information here, it started on October 14th. So, how many months do I have left to depreciate it if I'm assuming that I do my adjustment entry at the end of the year?
3.
3, yes.
3. Correct. We got to do October because it landed on the 14th. October, November, and December. Therefore, we need to calculate 3 months. Okay? So now that means we got to apply it. So our first year is technically only going to be the 3 months that this asset is going to be depreciated for. So let's go ahead and solve for the depreciation basis and the rate. Okay.
So, oh. So the 10,000 is the depreciation basis,
Okay, good.
and then we do the 1.5 by the 2 times the 2, which is the 40%,
Good.
and the depreciation expense is $4,000.
Okay. So that's what we solved for, correct? Now, because we are on a time limit, right? This is for the very first year. But the very first year, we placed it in October. So therefore, we need to recalculate what my depreciation expense is because this is for 1 full year. So now we have to take our $4,000, right? And how are we going to solve for only 3 out of the 12 months?
Here's my stuff. I know I did this. Trying to figure out times. Okay, so 3 divided by 12,
Mm-hmm.
0.25.
Good.
Okay, so let's see here. Oh, I'm sorry. Is 10 or 1,000.
1,000 is correct.
Okay.
So how you're going to solve for that is you're going to take the 4,000, right? We're going to multiply it by 3 and divide it by 12, or you could do 3 twelfths, which gives you 0.25. You're going to multiply it because this is a total of the 4,000 is a total of 12 months. We only need 3 out of the 12. So we're going to solve it as a fraction, or we're going to solve it as a decimal, which is only a quarter of a year. So now we only need a quarter of the year's worth of expense. So in this case, we took 4,000 and we multiply it by the 0.25 to get you a total of 1,000. Or what you could have done is you could have taken your rate and also multiplied it by the 25% to give you 40% to give you a total of 1,000. But in this case, okay, no, wait, 4,000 times 2.5, which you get 1,000. So yes. Okay. So that's how you solve for just a partial of the year. Okay. Any questions on how we did that?
No,
You said one more time, you did the
So we saw,
number of months that we knew we were gonna need,
mm-hmm,
which was 3 months.
mm-hmm,
So you went 3 months times 12, because there's actually 12 months, right? Or
not
3 times the
times,
4,000.
divide by 12 because you're
Oh,
only getting 3 months out of 12.
three, got it. Divided by 12 months. All
Mm-hmm,
right. I'm writing this down. Equals, and then you took that amount
mm-hmm.
and you divided that by 12.
Repeat
No,
which number divided by 12?
you took that, which gave you 4,000, and then you
So,
took the 4,000 and multiplied it.
yes, you took the 4,000 and you
Mhm.
multiply it either by 3 and divide by 12, or you could do by 2.5.
All right.
I mean 0.25.
Got it.
Okay, so then you're going to take a fourth, in other words, a fourth of $4,000.
Right. Yeah. Okay. Yeah, it was easier for me to do this one in my head because it was nice and round, but I need to know for ones that are not so even.
Mm-hmm, mm-hmm. So the best way to actually do this is go ahead and multiply it across. So once you get your depreciation expense, you can either divide by 12, right? So you get a number, and then you can times it by 3, or you can times by 3 and divide the whole thing by 12. That's also another way to do it too for those numbers that are extremely difficult, like 5 out of 12 months, right? So what you can do is take your depreciation expense, multiply it by the number of months that you are calculating for, and divide the whole thing by 12, and you should get a number. Okay? Instead of solving for the fraction first, because oftentimes when you get that fraction, sometimes it's not fun to have to punch all those extra like digits that are reflecting, right? So like you might have 1, 2, 3, 3, 3, 3, 3, 3, 3, 3. You may not want to type that in all millions of threes after the numbers. So the best way I would recommend is to multiply across. Okay, so we'll take the depreciation expense of 4,000, multiply it by 3, divide by 12, and you will get your answer. Okay, all right. Good. So with that being said, how do we journalize the first year's worth of depreciation?
Okay, that is the same as for the depreciation expense
Mm-hmm.
and accumulated depreciation.
Good. For what amount?
It is the depreciation expense is $1,000.
Good. For $1,000, right? Pretty straightforward and simple. That's the easiest part, is to journalize.
Okay,
Okay.
great.
Now, this is only assuming that you're doing your adjustment at the end of the year. Okay? There are multiple ways that you can decide whether it's a company thing or whether it's accounting thing. So what you can do is you can do it every month. If it makes sense to you, every quarter, whatever it makes sense to you for your business, or whenever you complete your accounting cycle, whether you think it's the best way to either do it according to your accounting period or make the adjustment at the end of the year. Okay? So again, chapter review, here you go. Here is what happens when this is what the formulas are. Okay, and then here below here in the bottom left corner, I've also entered in the formulas of what happens when your book value becomes less than salvage value. These are the formulas that you need to use to apply in order to solve working backwards. Okay, so at least you are aware of where the formulas came from and how to solve working backwards. And then lastly, a little piece of information just in case. So double declining is when you potentially plan on making it more than the in the beginning of its life versus towards the end. Okay. book value. Okay, so there you go. And any questions in regards to chapter 11.2?
I have nothing yet.
Okay.
Not so far.
Okay, so here we are with example. Is this the right one? Here is for 11.2 double declining example. So let's go ahead and get started with this example here. Okay, so, all right, question number 1 says you purchased a cash register for $300 with no salvage value. And its useful life is 5 years. And let's see what else. And can print up to 5,000 receipts. You put this cash register into service on January 8th. So let's go ahead and solve for what my asset is. So what is it? What did I buy?
3,000 or $300.
Oh, that's the asset cost. What's my actual asset? What did I buy?
Oh, a cash register.
Okay. So I bought a cash register, and how much did it cost me?
$300.
$300. All right. And do I have a salvage value?
No.
No, no salvage value, so it's 0. Okay. And what's its useful life?
5 years.
5 years. Okay. And when's the date I placed it in service?
January 8th.
January 8th. Okay. So assuming that 1 year is going to be ending in December 31st. So that means we're going to depreciate for the full year. Is that correct?
Yeah.
Okay, so let's go ahead and get started. So what's my depreciation expense, or depreciation basis for year 1?
$300.
$300, good. What's my rate going to be?
So that's the 40%.
Yes, it's 40%. So 1
1 divided by 5.
divided by 5 times 2, which gives you 40%. Good. So what is my depreciation expense going to be for my first year?
$120.
$120. Good. Making my accumulated depreciation for the first year to be?
$120.
Making my book value going to be?
$180.
$180. Okay, so with this piece of given information right here, what is my depreciation basis going to be for the second year?
180.
180. Good. We're going to take it from this top number here and bring it down. So 180 is going to be my starting point. So what do I know about my rate?
It stays the same, right?
It stays the same all the way through. So there you go. 40% all the way down. All right. So what's 180 times 40%?
40% is $72.
$72. Okay, good. And what is my accumulated depreciation going to be?
Let's see here. So, 20 minus the 72.
Not minus. We're adding them together.
Oh. Sorry, I'm reading it wrong.
No worries.
So, 120 plus 72 is 192.
192. Good. Bringing my new book value to be
Is 390 minus 192. Wait, it is the cost of the asset minus the accumulated depreciation. Correct?
So what's my cost of asset?
$12.
$12?
Wait, let me see if I type 192 minus 180.
Not 180. That's the book value. What's my cost of asset?
Oh, the whole 300.
The whole 300. There you go.
Oh, sorry. Okay. I'm just, all right, do that again. 108.
108, okay? And what do we know about 108? It's my beginning of the book value for year 3.
Oh, okay, so it'll be the next.
Correct.
Okay.
All right. So then, again, what is 40% of 180? I mean 108?
$43.20.
$43.20. Okay. Bringing my accumulated depreciation to be
$235.20.
good. Bringing my new book value to be
$64.80.
$64.80. Okay. So we're going to transfer that over to year 4. Okay. So then if I know my beginning of the year book value for year 4 is $64.80, what's 40% of that?
It was $25.92.
25.92. Good.
Plus 25, 92 is 261.12.
Good. Bringing my new book value to be
That is 300 minus 261 and 12 is $38.88.
good. Last but not least, we're going to bring that right across over to 38.88. What is 40% of 38.88?
$15.55.
$15.55, bringing my accumulated depreciation to be
$276.67.
good. And then lastly, what is my total book value going to be?
$23.33.
$23.33. So it's going to go so on and so forth until you reach its end of its life. In this case, when I reach my end of its life, it's still worth $23.33. What you can do is you could just scrap it off or, take a loss on disposal of asset, or you can continue to keep depreciating it till it becomes close to zero. In most cases, a lot of the places would just scrap it and just buy a new one. It's already 5 years old and it's a printer or a cash register. Right? There'll probably be a lot of buttons missing or things that it can't work for. Right? So let's go ahead and solve for question number 2 and question number 3. So assuming that the first year, okay, so what is going to be my depreciation expense for year 1? Or journalize it.
Okay. Expense.
What was that?
Hold on, I'm sorry, I was reading.
That's fine. I heard expense.
Yeah, the depreciation expense
Good.
And then
is,
the
oops, for the first year is the 120.
120. Good.
I'm always
Okay.
trying to write it while I'm talking, so.
That's completely fine. Okay.
And then, do the, oop,
cumulative depreciation.
Uh-huh. AQ.
Hopefully I said that right.
Accu,
I
yeah,
know, right?
accumulated depreciation.
Accumulated, okay.
Okay, ACUM for short.
Okay.
And it's for the
The
one.
same amount, the 120.
I don't know why it's negative here. Should just be 120. There you go. Good. So then, what about year 2? What's my journal gonna look like for year 2?
Okay, year 2 is going to again be the depreciation expense.
Mm-hmm.
And that is year 2 is $72.
Mm-hmm. So it's gonna look identical to this.
Right, so yeah, and the accumulation will be the 72 in the credit.
So $72 and $72. Right? Pretty
Can I ask
simple.
a question?
Go for it.
This is just kind of a random thought I'm having because we're using a cash register, but
Mm-hmm.
if you had multiples of these, would you have to do each item individually, or are you able to do them in a lump sum?
You can do a lump sum if you bought them all at the same time.
Okay, so like if it was a
Okay.
store that was just opening or something like that, and everything was going live at the same time, kind of
Mm-hmm.
thing.
Mm-hmm.
Okay.
And you'll see us doing grouping of assets when we move into our fictitious business. So if you were to have, let's say you went to the store, you bought all 3 cash registers at the same time, and you place them all into service at the same time, and they're all the same price, then you could just group them all together.
Okay.
Yeah. But let's say, for example, I bought 2 cash registers at 2 different times.
Uh-huh.
Then obviously the useful life will be different. And when you place them into service will also be different. So you may have to do separate, but when you place it onto paper, it could be either combined, or if you'd like to separate it, have cash register 1, cash register 2.
Okay.
But in that kind of situation, you would definitely want to calculate them separately and then add them together at the end.
Okay.
Okay. Good question though.
Thank you.
Okay. Any other questions in regards to questions 1 through 3?
Nothing yet.
Okay, so let's go ahead and dive right into question number 4. All right, let's take a look at this scenario here. So in this case, we have, okay, you purchase a computer for $1988, okay, which includes all fees, okay, with a salvage value of $200. All right, and its useful life is 5 years, and you place this computer into service on August 25th. Assume that the adjustments are made at the end of the year. Okay, so what asset did I buy?
Computer.
You bought a computer. Okay. And how much did that asset cost you?
$1,988.
Good. And what is the salvage life or salvage value on this?
It is $200.
$200. Okay. And and what is a useful life?
5 years.
5 years. And lastly, when did you place it into service?
August 25th.
August 25th. So what does that mean?
That means we're not going to do it until the next month.
Okay. All right.
For the rate, right?
Mm-hmm. For not the rate, for the actual depreciation expense.
Right, okay.
So how many months are we actually going to be totally depreciating this asset for?
Four.
4. So we have August, right? We're not doing August. We have September, October, November, and December. Total 4 months. Okay? So before we get to that, let's go ahead and solve for the depreciation basis. So what is the depreciation basis?
That is the $1,988.
Good. And what's the rate going to be?
I came up with the 0.40.
All right, so we take 1/4. All right, let me redo that again. So 1/4 times 2, which gives you 40%. Good, and we know that once we solve for 1, it's reflective throughout. Okay, so what is the depreciation expense going to be for the first year?
The 1988 times the 40%,
Mm-hmm.
that is $7,952.20.
Okay, now let's look at this carefully. The 795.20 is going to be reflecting for 1 whole year. How much can we actually depreciate it for?
For just the 4 months or so that it was.
Mm-hmm. So then we have to redo this.
Okay.
So we're going to multiply this. How many months are we going to do? 4?
Yes.
Out of how many months?
12.
12. Right? And what do you get?
Hold on a minute. I'm looking at you do it instead of me doing it. So, all right. Let's see here. It's that. $265.07.
Good, right? So I'm going to do equal round for this one because I have an actual long number or unrounded number.
Oh.
So there you go. We're doing 4 divided by 12, comma 2, not 52. And I get $265.07. So there you go. You calculated correctly. So that's how much you can actually depreciate it for. You can only depreciate it 4 out of the 12 months, which gives you starting from 765 down to 265. Okay. So what's my accumulated depreciation here?
It is still going to be the 265.07.
Good. Bringing my book value to be
That is the is $1,722.93.
yes. So that brings us to our second year's depreciation basis, right? So what is going to be my depreciation expense for the second year?
$689.17.
All right, so let me go ahead and $689.17, you said?
Yes, ma'am.
Okay, so bring in my total accumulated depreciation to be
$954.24.
good. Bringing my book value to be
$1,033.76.
good. I know. Hold on, I'm thinking about that too.
Instead of,
Okay, yeah, that's perfect. 6 plus 4 is 0. Plus 7, 2 plus 1 is 3, is 0. So good. It's even. Good. So therefore, that's my new depreciation basis for year 3. Okay. So what is 40% of this 1,033,676?
hold on one second, I messed something up.
Okay.
That's what I get when I'm turning right and then back left, and it's like a tennis match in here, sorry.
No worries. We have plenty of time, guys.
Okay. Okay, so the 1,033.76. 6 times the 0.40 is $413.50.
Good.
Okay. And now I have the 954.24 plus the 413.50. So that is new accumulated depreciation value of $1,367.74.
Good.
Okay, and then we have the, oops, I'm on 88 minus the 1,367.74. So the new book value is $620.26.
Good. Okay.
That carried over all the way to the new depreciation value.
Yes. Good. So that means for year 4, that's my new depreciation basis. Okay. Now let's go ahead and solve for 40% of $620.26.
$248.10.
Okay, 248 and 10 cents. Good. Bringing your total accumulated appreciation to be
Excuse me, $1,615.84.
good. Bringing your book value to be
$372.16.
good. So now we can carry that over.
So then the 372 and 16 times the 40% is $148.86. And then we have the previous year accumulation plus the 148.86, bringing the new accumulated depreciation to $1,764.71.
71. Let's see,
Yes.
86
One,
plus 4.
what?
We got 16, 15, 84 for the previous one.
Uh-huh.
Plus 148.86. That should give you an even number of 0.
16158.4 and then 14886. I don't know why it's not
Yeah, if you're working on Excel, it's probably because you didn't use rounded numbers.
rounding. I gotcha.
Yeah.
So
So it might be like,
round.
mhm.
Okay, I'll do it now. So oh, never mind. It's not letting me.
No, you could just go ahead,
There's
type
gonna
in the
get out of it.
numbers. Yeah.
I'm gonna start over. That's what I'm doing. So round. Yes,
First argument is the multiplication.
yes, yes. Oh,
Don't forget the comma and what
comma and
the 2.
2. Okay, that's what I was forgetting. So that's why it's yelling at me. Why is it still at 71?
Because maybe the previous number or the
Oh, is not rounded. Okay.
yeah.
Well, at this point, I will have to change that in a minute because now I'm just.
So just type it in first, so then when you come back and solve for it, start rounding from the depreciation expense. Okay.
Oops, hold on a second. 0. Okay, and then we're going to have the 1988 minus 176,470. So, sorry, the new book value is now $223.30.
I don't know if that is. Yes, 223.30, right?
Yep.
Okay. So that means you could still go for one more year of its book value, one more year of its life. Now, if I'm here approaching year 5 or year 6, how old is my actual asset?
Oh, it's only, you only got like, it's
You
half
have
a
8
year
months
of
left.
the, yeah.
So it's only 4 years and 8 months.
Yeah.
So that means we can go forth one more year, assuming that we need to depreciate the remaining 8 months. Okay? So go ahead and solve ahead. So what is my depreciation expense going to be? Sorry, I think my Excel calculated for me automatically. So what is 40% of 223.30?
Okay, so I went ahead
Mm-hmm.
and I only did it by the remaining 8 months. Was I
Okay.
not supposed to do it that way?
No, you and then did you end up getting your salvage value equaling?
Well, I haven't finished it yet, so
Okay.
I got 59.55 for my depreciation,
Okay.
which I took the what I got for the 40% and I divided it by 12, and then which was like $7 and change, and then I multiplied that by the remaining 8 months, which is how I got the 59.55. But I didn't know if that was right.
All right. So you decided went ahead and just only depreciated for the last 8 months of its remaining life. Correct?
Yeah, I was trying to be ahead because then I was like, well, then we're just gonna have to work backwards.
Mm-hmm. So
So,
here you go. So you got 59.55. Okay. So go ahead. What's next?
and then I added that to my depreciation, my cumulative depreciation, which gave me 1824.24.
Oh, sorry. Let me undo that. So 18, 24, 20.
Oh, 25. Yeah, I
Yeah.
didn't round it up. It's right. Yep.
Okay.
25. Okay.
And then giving your book value to be
$163.75.
so right there, boom. You still have to go back and fix it.
Because I'm below.
Exactly.
Damn. All that extra work for nothing.
Yes. again, remember, because it's double declining, right? We have the assumption that it may not even reach its end of its life.
All right.
It could end either earlier or it could extend for longer. So in this case, this one is very, very time sensitive. So I'm going to go ahead and work backwards below so you guys can see. So if I know that I need my ending balance to be the 200, right? So how do I solve for my depreciation, my accumulated depreciation? I have to work backwards now. What's my formula for that? Okay, I'll give you a hint here.
Hang on, I have it here. I gotta just pull it up. You're gonna take, you're gonna make your book value your salvage value,
Correct.
and you are going to subtract your accumulated difference to show what is still remaining. No?
I'm not quite sure what you mean by that.
Can I see the number? Yeah, I have that up. Can I see the numbers again so I can
Yeah,
see the numbers? I'm sorry.
I need to see the number. Going back and forth does not help me.
All right, go ahead. Here you go.
Okay,
Sorry.
I'm sorry. So you're gonna take the 18, no, that's not right. No, you're gonna take the 223.30 and minus the 200 from it.
Okay.
No? Okay.
So here's the formula. The formula is cost of the asset minus the book value to solve for accumulated depreciation. So let me cross these out so you guys don't get confused.
Oh, there we go. Cumulative depreciation minus the book value. Okay, so the cumulative depreciation minus the book value.
Okay, so so I have my book value. It's supposed to be equal to my salvage value. So in this perspective, right, what is my cost of the asset and what's my book value?
Your cost of the asset was the 1988.
Good. Minus
And
my
then
book value.
which we're making it the 200, the salvage value,
Mm-hmm.
which leaves us with $1,788.
Good. Now from there, there's also another formula below on that same worksheet. But this time I'm solving for depreciation expense. What does it say?
That you are going to take the new depreciated expense amount that we just figured out, which is 1788, and you're gonna subtract the accumulated depreciation amount of 1764.70.
Yes, the previous years. And what do we
Yeah.
get?
Yeah. Oh. Oops. Gosh darn it. Hold on.
That's
I
fine.
fat fingered it on the last number. $23.30.
Okay, so I see where you did when you were starting off your first thing. It's taking the difference between the two book values. And in fact, you do get $23.30. But the thing is, like, if you were to do that, right, find the difference between the two, right, then you would have to just know that that is your depreciation expense. And then you would just have to calculate forward that way.
Okay.
So you were kind of on the right track. That wasn't wrong. But just how you figured it out was also a longer way as well.
You
But
could say it was weird.
it's a little weird. Yes, it's a little weird.
Well, that's all right. I'm having trouble grasping it anyway. So, honestly, is this part going to be on the exam?
Yes.
It is. I really need to.
Yes, it 100% is. And tomorrow we will
I'm
practice.
not understanding what you're doing here. I'm just lost on that one for
Okay.
some reason.
So we're just working backwards. That's all it is.
Well, again, yeah. So I'm doing math in this computer, and then I have to keep turning around and go. So that doesn't help me, like I said. But that's, yeah. I gotta have. For me, I'm a person. I need to write everything down step by step. So if I don't have that, then I don't know what you're doing.
Okay.
That's how I learn. So I know it's here somewhere. So I just have to find that and write it down so I can see it. And
Uh-huh.
know that's the backward process.
Yes. All right. So again, utilize your review sheets for that because all of your formulas are there. You just plug in whatever you need. Okay. So then last thing for question number 5 and question number 6 is going to be to record the depreciation expense. So for the first year, so what was our first year?
265.07.
26507. Okay, so 26507. 26507 is our first year. Okay, and what's my journal going to look like?
Depreciation expense.
Mm-hmm.
And then accumulated depreciation.
Good. All right, question number 6 says, how do you journalize the depreciation expense for year number 2?
Year number 2 is also going to be the depreciation expense.
Mm-hmm.
And then accumulation depreciation.
Mm-hmm. Accumulated, good.
The amount is the $689.17.
Good. For 68917. 68917. Right. And that is it for today. I mean,
For that.
for this. Yes.
For 11-2.
For 11-2. So, with that being said, is there any other extra questions? Now, as far as step by step, what you can do is, again, utilize the review sheet. That's my best way to explain it, is to match up the, once your salvage value does not do this, so exactly what Michelle said. First thing you do is you're going to match up your book value to your salvage value. Then you're going to work backwards to solve for everything else. Yes, Michelle? You had a question?
I'm looking at mine and I don't know, but mine doesn't have the PowerPoint. I don't have that extra gray box on my thing.
I don't either. So that's the other thing I was wondering. It's like my review notes look different from what you have, and I don't have that other box either.
Oh.
I just don't have that when book value was less than salvage.
Oh, okay.
My slide sheet.
Oh.
Review.
Yeah,
it only has the two blue, and then the last one, the white one, the book value equals salvage.
Oh, okay. All right, then I assumed that I uploaded the new one, but okay, I'll re-upload this one. And I shall upload the other one. No, that's perfectly fine.
I mean, that's why I take a picture of it. If I don't see it somewhere else, I take a picture and then I'm going to write it down.
Okay, perfect. I'll go ahead and upload that for you guys.